Έχουμε έναν διακεκριμένο κύριο ομιλητή. Είναι ο κύριος Luigi Rizzo, ο οποίος είναι Managing Director του Financial Institutions Group της Goldman Sachs.
Well, first I have to apologize because I'll be doing my presentation in English. By way of introduction, as I think was said, I work at Goldman Sachs, where I'm a partner and I'm responsible for the banking sector in Europe and our coverage there. In the 15 minutes that I think are available to me for this first part of the panel, I will cover three things really in the spirit of the conference theme, which are really in the context of restoring confidence in the banking sector. I will spend 5 minutes talking about the US Supervisory Capital Assessment Program, which people have referred to as the stress test. Because I think so far, and time will tell, but so far it's the exercise that has contributed most in restoring some degree of confidence in the banking sector, at least in the US. I'll then spend 5 minutes talking about what are the trends that we see remaining in the US banking sector going forward. And I'll conclude in the final 5 minutes with what we see being the trends in the European banking sector. And then we can elaborate further. I think in terms of the crisis, by way of background, I think the trends are very familiar to everybody. I think beyond the top left chart, where you see the very significant underperformance in the equity markets of financial stocks, the rally that people have mentioned in the market in the last couple of months, really since the beginning of March, has only enabled stocks, you see that in the bottom chart at the top, has only enabled stocks to recover the ground that had been lost really up until the post-Lehman era, so barely back to those levels. Volatility has clearly increased very significantly. You see that in the top right chart, to levels, quite frankly, which are reflective of the very low volumes in the equity markets. Right now, on any given day in Europe in the banking sector, you find trading volumes which are a third of what they were at the peak. Liquidity, which as a panel we will come back to, has dried up with many pockets of liquidity. We've just picked up one on the bottom left chart, but many pockets of liquidity that existed for the banking sector that in a degree contributed to the crisis have disappeared. And obviously credit spreads have increased in a very significant manner, reflecting also where we are. Now, against that background, late February, we effectively saw this US stress test program come about. It was very public in the way it was conducted. I think if we have to try to apportion whether the US government wanted it to be so public, I think probably the view is that it became public probably against the will of the regulator itself, and once it was public and debated, I think there was no other way than doing it very publicly. Now, what was that program about? I mean, it's very simple. It's been talked about quite a lot. The regulator, with specific teams of professionals, went deep into the banks and tried to assess what would be the position 2 years forward. They looked at pre-provision earnings, so they took a view on what the bank could generate from an operating level. Importantly, they took very drastic assumptions on what could be the losses that those banks would make. Interestingly enough, they focused, and we'll come back to that, they focused on a ratio for banks which is very different from what the US had adopted in the past and is much more similar to what we've been accustomed to in Europe, which is what they call Tier 1 common ratio and is more similar to the core Tier 1 ratio in the way we know it in Europe. Each of the largest institutions in the US, i.e. with assets over $100 billion, had to undertake the test. The test started and the work started end of February, and it culminated with results announced early May. 19 banks were reviewed, and as we already know by now, 10, quote-unquote, didn't pass the test, which had two main targets, ensuring that you had Tier 1 capital of 6% at the end of a stress and core Tier 1 of 4% at the end of a stress. The 10 banks that didn't pass the test had a requirement to raise additional capital of $75 billion. Now, we'll come back in a second to what happened since, but what I think was quite fundamental to this and somehow unexpected is that effectively in the 3 to 4 weeks that have followed the announcement of the results, virtually all of the 19 banks have been able to go into the market and resolve their capital problem, resulting in amounts of equity capital raised in the market which are very significant, and we'll come back to that. Last but not least, we all remember that in the US, the TARP money from the government had been injected to the banks, and the US government said we will allow banks to repay the government money as long as their capital ratios are sufficient and as long as they can fund themselves and demonstrate that they can fund themselves at 5 years over in the market without government and federal guarantees, which now a number of banks, including my institution, has done. If we look at the results of the stress test, obviously the $75 billion is a number that has been talked about quite a lot. I would like to point out that, by the way, the number was much bigger than $75 billion. The stress test took into account the capital initiatives in the first quarter. Otherwise, that number would have been well into the hundreds of billion dollars, but money had already been raised. Of those $75 billion, the vast majority of the banks that failed mostly, the vast majority, 65 out of the $75 billion, were due to a shortfall in core tier 1. Now, what I've done here on this page to the right of the chart is I've color-coded the core tier 1 ratio US styles of the 19 banks that went into the test. The dark blue color are the ratios of the banks that passed, and the light blue colors are the ratios of the banks that failed. And I think for any one of us in Europe, looking at those numbers, in particularly the averages at the top, you know, some of our clients have told us in discussions, half-jokingly, that it didn't take a lot of science to realize that banks that in aggregate at core tier 1 ratios of 4.3% would need to raise capital. And I think it's an important point, obviously. In the US banks from that metric that failed the test were very thinly capitalized by European standards going forward. The banks that passed the test had, on average, a ratio of anywhere between 7.5% and 8.5% on average, which compares very well to the levels that we have generally in Europe. And we'll see in a second that those banks have raised additional capital since then. And so those banks that passed the test in the US are now operating at very healthy ratios, even compared to Europe. Now, what was the entire requirement in the US? If you include the 75 other banks that were not part of the stress test and the amount of capital that is required to repay TARP, the total capital requirement of the US banking sector is estimated at around $130 billion. Of that, you see on the right where we expect that money to come from. One thing I point your attention to is the $55 billion of equity requirement, which is in dotted lines, has already been raised in the last 3 to 4 weeks by the banks in general. Indeed, you see here the banks that passed the test, and on aggregate, they've raised around $22 billion of equity in the market from private sources of capital. And if you go to the banks that failed the test, on aggregate, they've raised around $35 billion of equity in the market. One thing I would say particularly striking from this exercise is that certainly our institution, for First, was very surprised at the receptivity of the institutional market for banks that actually failed the test. We expected the markets to be receptive for banks that have passed, but the markets were also open for the institutions that actually failed. Now, one word of caution or past evidence around the rally that we've seen in the last couple of months in the market. Certainly the experience in the US has been that in 2008, we had 2 short rallies in the market, and both of those rallies were interrupted by very significant capital raising exercises. You see the first window of 2008 saw around $34 billion of equity raised in the US. I would underline that that was the window where in Europe, RBS, UBS were raising money at that point in time. The second window later in the year saw $55 billion of equity being raised in the US. That was the window that the likes of Santander and others in Europe utilized last year. And both of those windows shut after massive capital raising. As I said, in the very back end of this chart, around $55 billion of money have been raised so far, and the markets so far, but we'll come back to the fragility of the markets so far have reacted to this capital wave in a better manner than they did in the previous ones. Moving to the US, where are we in the US? I mean, there's no doubt, and I started with one of the bleakest charts to actually make the point. There is no doubt that the situation in the US continues to deteriorate in terms of asset quality and what filters through the system. The first chart in particular shows the annualized levels of non-performing assets formation. and it goes from the past to the present. As you can see in Q1, we are the highest level so far of annualized non-performing assets formation. So clearly the pace of new creation of non-performing assets, it's certainly not slowing down, and if anything, it's accelerating. The chart to the right, and we've done a couple of those charts to put things into historical perspective, shows the current levels of non-performing assets in the system, which are the light blue columns, versus the average of the prior crisis in the US over a very long period of time. And what you see is that the behavior so far of non-performing assets creation is very much in line with year 0, year 1, year 2 of previous crises. What you see is that, as we all know, the degree of magnitude of the current crisis far outstrips any of the precedents that we had before. If the behavior of the current crisis were to pursue, there is a sense that those levels might come down. However, as you'll see now, what we see is that the two biggest factors driving non-performing assets, and again, it's not a surprise for most of us in the banking sector, are number one, and in the US particularly, the decreases in house prices. The US, like Spain, like the UK, like Northern Ireland and Ireland, has suffered from a real estate bubble. And what you see here is that the correlation between the decreases or increases in prices of real estate and the formation of non-performing assets is very, very high. It's 90%. And as you see in the top left of the chart, you find the last 5 quarters in the US, i.e. very meaningful decreases in real estate prices translate in very high levels of non-performing assets. So lesson number one, which we all know about, is until the housing prices in the US stabilize or increase, effectively the balance sheet and the wealth of families will continue to go down, and non-performing assets will continue to materialize on all of the asset classes. Second element, obviously, which is more relevant for Europe, generally outside the countries I mentioned, is unemployment levels. And again, as you would expect, the biggest trigger for non-performing assets, particularly on the big mortgage class, is effectively unemployment. That is the one trigger that will create mainly defaults. And again, as you would expect, there's a high correlation. And again, in the US, if you look at the right-hand side of the chart, the unemployment levels additional creation is accelerating quarter on quarter. You see first quarter 08, second quarter, third quarter, effectively going up at the extreme right of the chart. And therefore, there is actually an indication that possibly that will continue to fuel the non-performing assets until it stabilizes. What can we expect based on prior evidence of former cycles in terms of where we're going? But unfortunately, the indication of the past is that it takes time, and it will take time to resolve. A couple of benchmarks, if you look at reserves, i.e. provisioning levels, you see from prior evidence that effectively it will probably peak in year 3 and year 4. So effectively 2010, 2011. And we'll see in a second that's effectively the guidance that you guessed mostly from European banks, depending on the various countries, but mostly from European banks. Non-performing loans, bottom left. When do you expect it to peak? Again, probably in year 3, i.e. 2010. Losses, which obviously are very different from the provisions that are taken against non-performing assets. Well, you see in the top right chart, losses again are expected probably to peak in year 4, as we would expect, because that's when the top non-performing assets of year 3 go through the system, as then you know how much you've managed to recover it. So for people that are saying we've turned the corner, the banking system is going to go back to 12-year levels, it's true for the equity market that looks 4 or 5 years ahead. I don't think it's true for the operators in the market, and I think that's our experience. Last but not least, return on equity, which is an important factor going forward for most of the banks. Again, the experience is that return on equity will only go back probably to more recent levels over a period of 5, 6, 7 years, which again I think is expected if we ever go back to those levels. Some positive note, or at least trying to give some positive note, for the very first time in many, many quarters, US banks have shown an improvement in tangible book. What does it mean? It means that for the very first time in many quarters, banks have actually demonstrated pre-provisioning levels that more than compensate on one side the provisions and on the other side the growth of risk-weighted assets. It is encouraging because we'll see when we come to Europe that that has been the saving grace of European banks. European banks have continued to be profitable through the cycle because what they were making on their portfolio more than outstripped the provisions that they were taking on the portfolio. And you see the ratios on the right-hand side of the page. Europe, just to conclude the 15 minutes I had, and I see I'm already overboard, very quickly. What is the feedback we got from most of our clients? We just held a conference a few weeks ago in Frankfurt. We invited the top players in Europe to come and talk to investors. Various buckets. Number one, a view from the banking system that the crisis is feeling less acute. I think the only way we reconcile that statement with the charts that we've only seen is that for the banking players, what was perceived as the worst of the crisis is not the credit cycle, which is part of the banking business, but the liquidity issues that we had back in October. That, with a lot of interventions we will debate as a panel, has helped to ease that pressure, and now banks feel that they are dealing with issues that they are at least equipped to deal with, which are credit cycle. No rush in Europe to repay the government money. We saw zero intention, willingness from European banks to repay the government money. Why is that? I think it's pretty simple. In the US, there is a big stigma in getting money from the government. People feel that it is a failure of the private sector. Banks in general are also smaller in terms of what they represent. So the largest bank in America is 10% of customer loans. In Europe, banks are bigger. They are part of the government stakeholder dialogue. Government, in one way or another, even if they don't have shares or preferred in the banks, are always going to be someone that you need to deal with. And therefore, the view is that it's not as uncomfortable as it is in the US. Plus, the capital is still to be used until things are clearly better. Volumes are clearly coming down. It's a fact of supply and demand. On the supply side, European banks are more leveraged than US banks, and so that has to come down over the next 2 to 3 years. And clearly on the demand side, it has come down quite dramatically. Credit quality, all the signals are that it gets worse from here. The only question is, how bad does it get in various markets, and what does it mean for the various banks? Credit buffer, which, as I said, is the saving grace of European banks. European banks can go proudly and say that generally, in their vast majority, the pre-provisioning earnings are 1.5, 2 times multiples of their provisions, i.e. they continue to have margins on the business they wrote, which more than outstrips the risk. It's a central metric. We think that that's what's going to make a differentiation in the valuation of various banks going forward in 2010 and 11. Net interest margins, we've summarized views from various countries, various banks, but the view is that the benefits that one could get in terms of bigger lending spreads and possibly some other interventions that are out there are going to be compensated by the higher cost of deposits. And then finally, capital markets revenues within the mix of bank income continues to be pretty strong. And so a lot of banks in Europe that have strong capital market exposure have managed to show still reasonably healthy earnings because of that line. Where does the sector go from here? I think we've passed the phase one in Europe, which was really banks that have big exposure to the US or to structurally impaired asset classes and had to take capital to make up for that exposure. I think now we are firmly into a credit cycle, and I think the big question on everybody's mind is, what does the business model become going in 2010 when the regulators have already indicated that once the crisis eases, regulators will put pressure on banks to raise levels to levels that are more sustainable, whatever that is. And that will clearly have an impact on leverage. It will have an impact on return on equity. Phase 3, differentiating in terms of evaluation of the banks, clearly will be the level of earnings that they can generate on their capital and effectively how well they manage the current crisis. So that's it for my introductory remark. We will now go back to the panel, and I'm sure we'll be happy to take your questions. Thank you very much.